So we got Omotola Abimbola from one of the investment analysts from Afrinvest to talk us through banking on the banking sector and the banking stocks in 2017. Let's start to wind up the year gradually. Some of us ain't going anywhere despite the holidays, but for folks like Omotola here, we need to start winding up with them before they get out of town. Good morning. Hope you had a nice weekend.
Yeah, sure I did.
Yes. Banking stocks are always sweet. It's been a very decent year, isn't it?
Correct. Yeah, it's been a stellar year, I would say. If you look at the performance of banks, both in terms of their earnings, as well as the performance of their securities, both equity and debt securities, earnings have been very strong in 2017. Following what happened in 2016, looking at gross earnings and the profit after tax of banking stocks as of half year, they were up by over 20% each, driven by the outperformance of the tier 1 banks who have leveraged on the high yield environment, for government securities to increase their interest income. Non-interest income has not been quite strong due to the high base effects of 2016. In 2016, we had the large FX rate movements from around 199 to 305 naira to $1. So that led to the high FX revaluation gains recorded by banks in 2016. So due to that high base effects, we haven't seen such level of non-interest income in 2017. However, for the tier 2 banks, as well as some few tier 1 banks, they have leveraged on improvements in the trading environment in Nigeria because of the better macroeconomic fundamentals and improvement in capital market sentiment. They have been able to record, very strong momentum in terms of trading income that has supported their performance as well. So that's led to the improvements we saw in gross earnings. Now, looking at the profit after tax, we have seen an increase in cost of fund of banks because of the tight liquidity, in the financial services sector as a result of the central bank's aggressive monetary policy tightening. That has led to an increase in cost of funds for banks. However, the impact of that has been offset by the high interest income as well as the moderation in the impairment charges of banks. So that led to the over 20% growth in PAT of the industry.
So the NPL, so the non-performing loans were there. They look really ugly in some way.
They do.
And they're not booking more loans. A few of the banks have deposits a little bit sluggish.
Yeah.
But they still turn out decent earnings.
Correct. In terms of balance sheet performance, like you mentioned, we have seen two key trends. Number one, loans aren't growing again because of the high risk environment and the fact that liquidity is quite tight in the financial marketplace. So, as a bank, the question you want to ask yourself is, which sector do I want to lend to? And considering the risk environment, is it optimal for me to be advancing loans, to these sectors at the moment? Or should I just take advantage of the high yield on government securities to reallocate my assets?
So basically, it's a trading year.
It's been a trading year.
2017 was a trading year.
Yeah, indeed. In fact, in June 2017, Afrinvest released a research report which it tagged the great macro trade of 2017. Because of the improvement.
I've got to look there for that and read it up.
You have to look at it.
I've got to look it up. Yeah. I've got to look up that a great macro trade
of 2017.
That was what we did on Broad Street.
Exactly.
Technically speaking.
Exactly.
So we just lending money to the government and creaming off nice percentage. The FX was there on the other side. So we're able to, heal ourselves of the 2016 economic recession.
Yeah, partly. However, if you're looking at non-oil sector growth as well, you will say that although we are in a recovery mode, but the recovery is not broad-based yet, it's still majorly anchored by the improving oil production volume, which is leading to faster growth of the oil sector. Meanwhile, the non-oil sector, which is more reflective of the economic fundamentals and the income of Nigerians, we haven't seen the same level of traction there. However, taking it a bit further to look at the performance of banking stocks in the year, you will see that the improvements in earnings, as well as the improvements in the macroeconomic sentiment, which has led to higher pricing of Nigerian stocks, it has led to the outperformance of banking stocks in 2017. Year to date, right now, the banking sector has returned over 70%. Right, year to date, which has beaten,
that's more than about 30% of the broader market.
Of the broader markets, in 2017. Particularly, the rally has been driven, more by tier 1 banks, talking about FBNH, Guarantee Trust Bank, ETI, Zenith, Access, and I think UBA as well.
Stanbic?
Stanbic is a tier 2 bank, but the interesting thing about Stanbic is that I
want us to play them. Tier 1 versus Tier 2 versus Tier 3.
We classify banks based on their total assets. So if you have total assets exceeding 2 trillion naira, we call you a tier 1 bank. Less than that is a tier 2 bank. However, the interesting case about Stanbic is that although it is a tier 2 bank based on its total assets, the fact that it has very diversified, presence in the Nigerian financial services industry. They have the biggest PFA in the country, one of the biggest capital markets players as well in terms of securities trading.
Funds.
They have market leaders, yes. Exactly. So if you're looking at their return in terms of profitability, their profile matches up to that of the tier 1 banks. The return on equity is above 20%, which is similar to what obtains for tier 1 banks. That is why till today, Stanbic has the highest valuation multiple of the tier 2 banks. They are trading at around 2.7 times price to book right now, compared to the average of around 0.3, 0.4 times for the tier 2 banks. So they hire a tier 2 bank in principle, but their profile as well as their profitability matches to that of the tier 1 banks. And the return and the significant traction we have seen in the banking sector in 2017 has also been partly driven by the trading activity on Stanbic as well. Yet today the stock has gone up by more than 100%. Because 2016 was quite underwhelming for them. But in 2017, they've been able to return to, attractive level of profitability.
Clearing up some of those regulatory issues.
Exactly. Impairments are still growing, but due to the high interest environment, as well as the performance of their non-interest income as well, because of their, PFA license and their capital markets, subsidiary, which has seen an improvement because of the, largely positive macroeconomic backdrop. So that has driven up their non-interest income as well. So performance-wise, both in terms of earnings and performance of their securities, they've done quite well.
I'm still playing Premier League 1, the first and the second, and then the third.
Yeah.
So if I'm looking at a portfolio and
right.
I think, look, I want something diversified, should I buy tier 2 or tier 3 banks? Can I play them because I have some, sentiments, put it that way. I'm sentimental to certain stocks in tier 3.
That's a fantastic question, because right now, we've been getting 2 questions from our clients. The first is that, with the significant rally we've seen in the tier 1 space, is there still any potential upside left? That what else can I buy in the tier 1 space? They've already returned more than 50% year to date. So is there still any upside potential to be captured? The second question is that, since we have seen improvements in the economy, is the risk landscape now accommodative enough for me to take the risk of buying a tier 2 bank? And our responses have been that, one, although the tier 1 banks have outperformed, right, we still think there is still a bit more potential, for them to even do better going forward. And number 2, we still think that the environment is still not conducive enough for an investor with a short-term perspective to take the risk of investing in a tier 2 bank. The tier 2 banks, in principle, they have a lower valuation multiple and they have greater upside potential. But because of their balance sheet issues, particularly, their high cost of fund, their high non-performing loans ratio, and their high level of operating leverage, meaning high cost to income ratio, that means that, or they all mean that, if you are taking the risk of investing in a tier 2 bank right now, the weak sentiment for these stocks will mean that the return you are hoping to get might not be captured in the shorter term. It will be a longer term play. It could be a value trap. So we still think that if you're a patient investor with long-term capital, a year, 2, 3 years down the line, the potential in the tier 2 segments is quite high, and would recommend you to invest in them. But if you have
a not a very small amount, and that's why you go with 10,000 naira.
Well, I guess so.
And I'm serious, because if it's a long-term horizon, 10,000 will just get soaked up.
Yeah, exactly. It will be a value trap. So we still think that we still prefer the quality stocks in the banking sector than those with low multiples. So we are still buying the tier 1 banks.
What about tier 3? And I'm sure we have 1 or 2 in tier 3. I'm sure. You and I, we know that.
Well, according to
Skybank, for example. Is it in tier 2 or tier 3?
For Afrinvest, we do only tier 1 and tier 2 segments.
You don't touch tier 3?
For the CBN has a tier 3 classification, which are banks that have, much more lower total assets. So the banks, regional banks like, regional banks and some national banks like Unity and Wema, They're classified within the tier 3 segments. And for these banks as well, the major issue has still been about their asset quality. They have quite weak asset quality, one, and then they have very high cost of fund, which has been, dragging their profitability, substantially. So for us, we still think that investors with a, shorter term perspective should still stick with quality stocks over those with seemingly low valuation multiples in the sector.
Is there anything, if you look at the fundamental and technical analysis, and thank you very much for providing a lot of fundamental overlay there for us to understand, but fundamentally, what do you think will likely come in to change the scenario or improve the fortunes of not just tier 1, but the tier 2 and tier 3? And again, I'm going to ask this question. Is there any day very soon when we see a bank share at 50 naira, 60, or maybe 100?
It might happen very soon. Stanbic today is at 42. JC Bank is over 40 naira as well. So, 50 might happen very soon. You never can tell. But going back to your question of the fundamentals to look out for. Like I mentioned initially, the high yield on government securities has been the major driver of earnings in the last 1 year. However, if you're looking at the yield environment over the past 3 or 4 months, it has been moderating gradually. And if you study the Q3 result of most banks, you will see that there was a moderation in their interest income. And that's going to continue in Q4 because of the monetary easing signaling by the Central Bank of Nigeria, as well as the recent strategy by the federal government to diversify their sources of borrowing towards the external sector, the external loans, and domestic borrowing. So all these mean that the outlook for interest rates in the economy is quite positive, and we should see a decline in yields going forward. Further decline in yields going forward.
That is something. That when yields start going down and interest rates start going down, correct, that's when the tide goes out and we'll see who's been swimming naked. We'll come back after the break. Stick around. Omotola Abimbola from Afrinvest. And see the true nature of banks in 2018 with Omotola Abimbola, investment analyst from Afrinvest. So we got yields beginning to trend lower, correct, and that's will let it go. Then central bank becomes more accommodatory, more dovish in 2018. So when all this go out of the banking sector, what will be there for us to see? Let's trade the banks into the new year.
I think the declining yield environment is going to create some winners and some losers. The winners will be the tier 2 banks who have been battling with high cost of funds as a result of the tight monetary policy. So with declining yield environments and improvement in liquidity in the financial system, we should see cost of funds gradually inching downwards, for the tier 2 banks, and that'll be positive on their net interest income. However, for the tier 1 banks, they are arguably going to be the losers because for them they already have low cost of fund, but they've been able to realize so much more from their asset because of the high yield environment.
They've been piling more government securities.
So, and as yield starts declining, that's going to take a hit on their interest income and possibly their net interest income as well.
A very quick question from one of our viewers. It says, on Twitter, what can we do to get banks geared towards more venture capital instead of the interest-driven banking we have now?
I think banks are also economic agents, and typically they respond to incentives and disincentives, right? So for banks,
fair enough.
So for banks to be able to take a much more longer-term perspective in terms of creating assets in the economy, the incentives have to be right in terms of the risk landscape for the banks. That are they sure that the risk they are creating, the longer-term risk they are creating, are they sure that the risks are viable and we give them viable returns? So for them to do this, I think government has to deepen reforms in the real sector. We need to see improvements in infrastructure to make businesses more competitive and make real sector more appealing to banks to lend to. That's number one. And then government has also stopped crowding out the private sector, right? So we need to see both shifts happening for banks to be able to create more risk in the economy, more risk assets in the economy.
A very quick one. Yes, that's still trading banks into the new year. Do you see the 50 naira per share in the banking sector in 2018? Do you think we're close?
Possibly. I think we are close.
What will drive that? Fourth quarter earnings, budget 2018, ERGP, what?
It's going to be either of two things. either earnings, if earnings improve in Q4 and possibly by Q1 2018, that's going to, be a catalyst for markets return. And if we see further expansion in valuation multiples, if we see the macroeconomic landscape, further improving, if we see GDP growth returning to the high, to over 5%, if we see FS liquidity further deepening, that may lead investors to further reassess the pricing of Nigerian assets, and probably, lead to expansion in valuation multiples. So if we see earnings expand, that might possibly, drive the
pricing sentiment,
on
the part of. Okay, we'll have some time in the future before the year ends to talk about the dividend side of things.
Sure.
We couldn't get into that today.
Sure.
Omotola Abimbola, thank you very much. Do have a very great week ahead of you. And that's about all for